Hey everybody, my name is Dr. Brian Winter. I'm a tax attorney and a tax professor. In this video today, we're going to be talking about the dividends received deduction. So what is the dividends received deduction? The dividends received deduction is a deduction that a corporation receives, so a C corporation receives a deduction when it receives dividends from another corporation in which it owns stock. So for example, as an individual, if you own stock in Fastenal or Pfizer or Enron or whatever corporation, the corporation has its earnings and they pay taxes at 21%. And then they're going to make a distribution to you. And if it's a qualifying distribution, what's going to happen is you're going to pay taxes at your preferential tax rate of 0, 15, or 20%, depending on what your taxable income is, right? So it's taxed at 21%, and then it's taxed at your individual rate. But let's say that we have Fastenal Corporation, and then we're going to go with Enron that owns some shares in Fastenal Corporation, because corporations can own shares in other corporations. That's fine. There's nothing wrong with that. Well, let's say that we have Fastenal paying dividends to all their shareholders, with one of those shareholders being Enron. So when Fastenal Corporation made money, it paid taxes at this corporate rate of 21%. This is applying to C corporations. So it paid taxes at the 21% rate. Well, the individuals who received it, you and I, we received the dividend and we paid that 0, 15, or 20. But when another corporation, Enron in our example, receives this distribution, they pay at their 21% tax rate. They don't have a preferential tax rate. Okay, so now we've had the money that was taxed when Fastenal earned it, and then it was given to a distribution over to Enron, and Enron paid 21%. But now let's say that Pfizer owns stock in Enron. So Enron goes ahead and pays a dividend, and all of a sudden Pfizer's getting this money, right? Well, we have Pfizer now paying taxes at 21%. So the dividend income that originated with Fastenal, and then it went to Enron, and then it went to Pfizer, all of a sudden it's 21, 21, 21. We're getting multiple levels of taxes, right? And then if Pfizer goes ahead and makes distributions and it's just to individual shareholders, well, they're being taxed at their 0, 15, or 20% rate, but all of a sudden that's the fourth time it's been taxed, right? Well, that doesn't seem to follow within the policies of what our tax code tries to accomplish. So what happens is the code has this deduction. It's called the Dividends Received Deduction for corporations that receive dividends from another corporation. So on this table here, you can see what the percentages are, what the dividend deduction is going to be, the percentage is going to be. So if we look at the ownership percentage all the way over to your left hand side, we see under 19%, so it goes all the way up to 19%, a corporation that owns, say, 2%. So in my example, we're going to say Enron owns 2% of Fastenal. All right? Well, any dividends that Enron receives from Fastenal is going to be taxed, it's going to have a 50% dividends received deduction. They're going to have a deduction of half of the dividends that they receive. So only half of it's going to be taxed. Now, if instead of owning 2%, we said that Enron owned 51%, it could have been 23%. It doesn't matter. It's between 20 to 79% ownership. So if they own that amount between 20 and 79%, so 52% or whatever, then what we're going to see is Enron's going to receive a dividends received deduction of 65%. So they're only paying taxes on 35% of that dividend. And then if they own 80% or more, so Enron owns 80% more of Fastenal Corporation, then any dividends that Enron is receiving is going to be 100% dividends received deduction. They're not going to pay taxes on it. So you need to know this different 50, 65, and 100% percentage rates, because that's an important part for in-class exams, CPA exams, or EA exams. You're often tested on these things. Now, when we say that there's a deduction of 50, 65, or 100%, right? That's a little bit simplified, because what we're going to have to do is we're going to look at the dividends received. So we're going to apply that 50% to dividends received, or the 65% to the dividends received, or the 100% to the dividends received, which makes sense. But there's a limit, a ceiling, if you will. And what that ceiling applies to are taxable income. So we're going to see what our taxable income is, our revenue and our expenses in there. We need to modify taxable income. And then we're going to work our way over to our taxable income. And we're going to apply that same 50%, 65%, or 100%. Now, I could talk about this all day long, but it's easier to understand if we look at it in terms of a couple examples. So for the rest of this video, I'm just going to work through a couple examples and make sure you have these concepts down. So let's go ahead and start on that. So here's our first problem that we're going to work through to make sure that we're able to get this down. So we have Longhorns Incorporated owns 30% of Gator Corporation. During the year, Longhorn earns $100,000 in operating revenue and receives $100,000 of dividends from Gator. So a total income of $200,000. They also incur $10,000 of regular business expenses not related to stocks or dividends. Determine the Gator dividend received deduction and taxable income after the dividends received deduction. Okay, this is a type of fact pattern we could expect to see. All right, so we have Longhorn, this owning some of a Gator Corporation, and now they're receiving a dividend on it. So what we need to do first, and you can see the steps all the way to the left, right? We have our dividends received, our gross income, our expenses to get to modified taxable income. So what we start out with is we're trying to figure out, well, what is our gross income? Okay, so our dividends received was $100,000. I could have added a second line saying our revenue received, because it shows us that we receive $100,000 of operating revenue. But instead what I decided to do is I just kind of added those together. So we had dividends received $100,000 plus our operating revenue of $100,000. So our gross income is $200,000. So we have $200,000 of gross income. All right. Our expenses are $10,000 for our regular business expenses. Seems pretty low to us, but we have some kind of regular business expenses of $10,000. Great, that was given as well. So to get to modified taxable income, we're taking operating income plus we're taking the dividends we received, so $200,000, minus our business expenses of $10,000. So if we look at $200,000 minus 10, we're going to have $190,000. That's going to be our modified taxable income. Okay, so we have $190,000 of modified taxable income. Awesome. Now, what we need to do is we need to figure out, well, what percentage do we own? Is it between 0 and 19, so we get a 50% dividends received deduction, between 20 and 79%, so it's a 65% deduction, or 80% or more, where it's a 100% dividends received deduction? Well, I see in the first line it says Longhorn Inc. owns 30% of Gator Corporation. Well, that is between 20 and 79%, so we should be getting a 65% dividends received deduction. All right, so we've now calculated our modified taxable income, revenue with dividends minus our expenses, and we've figured out we own 65%, so we know our ownership share. I'm sorry, 30%, so we know we're using the 65% percentage. Then what we do is we say, well, how much did we receive in dividends? Well, we already answered that. It's on the very top line that I put up there. Dividends received were $100,000. So if we received $100,000 of dividends, and we own 30% of the corporation, then we get 65% of a dividends received deduction. So if we multiply the $100,000 of dividends received and the 65% dividends received deduction, that means we have a dividends received deduction of $65,000. Okay? Our dividends received deduction is $65,000. Now, here's a step that's important to note, because what we generally do is we're going to say we're going to have a ceiling of modified taxable income, but that ceiling doesn't always apply. Okay, so this isn't like some of the other tests in the past that we've dealt with, that like QBI, where we said, 20% of modified taxable incomes are ceiling. No, this doesn't apply like that, right? What happens here is we don't always need that modified taxable income limit. Here's when we do not need it. If we look at our tentative dividends received deduction of $65,000, and let's say that we look at modified taxable income of $190,000, if that dividend received deduction would have resulted in a net loss, then we get the full $65,000 dividends received deduction. We don't even have to take the step 2 of modified taxable income. But when I look at the problem here, I'm seeing modified taxable income of $190,000. If I went ahead and I subtracted it out, $190,000 minus 65, I get $125,000. That's still positive. All right. So that's why you see, would there be an NOL? If yes, use tentative dividends received deduction. We would use $65,000. But that's not the facts in this case. So we now need to go to the limiting factor. What we're going to do is we're going to say, let's take 65% of our modified taxable income, and then we're going to end up having to select the lower of the tentative dividends received deduction or the modified taxable income limit. So our modified taxable income was $190,000, right? That was where we did our operating income plus our dividends minus our business expenses gave us $190,000. So we go 190 times 65%, and that comes out to $123,500. Well, our tentative dividends received deduction of $65,000 is lower than our $123,500. So we're going to get the full $65,000 in this problem. Okay. Let me point something out real quick. When I showed you the modified taxable income limit, and I said we took the $190,000 times 65%, the percentage we use for the modified taxable income limit will always be the same percentage that we use for the dividends received deduction percentage. So if we had only owned 10% of the corporation, well, if you own 10%, that's less than 20, so it's between 0 and 19. We would have used 50% for the dividends received deduction and 50% for the modified taxable income. If we'd owned 83%, we would have used 100% for dividends received deduction and 100% for modified taxable income. So once you determine what percentage you're using, you use it twice. It's going to be the same percentage both times. Anyway, that's the way that we're going to solve these problems, and that's your first example. I do want to work through another example with you. One's, I think, a little bit more complicated, but we're going to work through it and make sure that you are able to solve these types of things for your exams. All right. So let's go ahead and take a look at the next one. All right, well, let's take a look at problem 3 now. And what we're looking at here is Tiger Inc. owns 25% of the Buckeye Corporation. During the year, the Tigers earned $20,000 of operating revenue and received $100,000 of dividends from Buckeyes. They also incur $80,000 of regular business expenses. The Tigers held the Buckeye stock for 60 days around the ex-dividend date. All right, so they're meeting the requirements. We're going to be good on that. So let's go ahead and apply this. Now what we have here is, as we look at the fact pattern, right? So we're looking at the fact pattern. What we need to do is we need to kind of figure out, well, how much are the dividends going to be? I'm looking at it, I'm saying, okay, there's $100,000 of dividends from the Buckeyes. Great. So I know we're going to have a dividend received of $100,000. The next thing I need to do is I need to figure out, well, what is our gross income? So if we received $20,000 in operating income and $100,000 of dividends, that's it. We only received $120,000. So I'll take the $100,000 of dividends plus the $20,000 of operating revenue. So we have $120,000. Well, now we need to figure out what our expenses are, because we're taking that income, right? The dividends plus operating income minus expenses to get to our modified taxable income. Well, if we have expenses and it says they incur $80,000 of regular business expenses, we're going to go ahead and we're going to say we have $120,000 of gross income. Expenses are $80,000. That means our modified taxable income is $40,000, right? 120 minus 80 is $40,000. Well, we own 25% of the corporation. So because we have between 20 and 79%, that's a 65% dividends received deduction. So just like our last problem, it's either going to be 50, 65, or 100, and both of these have fallen within that big range between 20 and 79%. So we're at 65%. All right, we already know that we have $100,000 of dividends received. So we go 100,000 times the 65% dividends received deduction, and we have a $65,000 dividend received deduction. Okay, so let's take a look at this. If we put $65,000 down as our tentative dividends received deduction, we need to then look at the next question. Would there be a net operating loss? Yeah. We have $40,000 of taxable income. If we subtract out our dividends received deduction of $65,000, that's a loss, right? We would have a loss of $25,000. Well, because it would result in a net operating loss, then what's going to happen is we get the full dividends received deduction. We're not hitting the limit on that. We don't even have to worry about doing anymore. Our answer to this question is $65,000. Okay? $65,000. And our taxable income after the dividends received deduction will be $40,000 modified taxable income minus $65,000, which is going to give us $25,000 net operating loss. So that's it. That's how we solve this. But here's what I want to do. I want to talk about one more thing with this problem before I stop this recording. All right, so both examples we did, we never got to see an example where we were limited by that 65% of our modified taxable income. All right, we didn't have to deal with that. Well, let's look at what would have happened had we said it didn't end up in a net operating loss or a loss. So we would have said we had modified taxable income of $40,000. If we took that $40,000 times 65%, because we use 65% for the dividends received deduction because we own 25% of the corporation, 40,000 times 65%, right? We would have said, oh, well, that's going to be lower than $65,000. Because of that, we would have taken the amount that we got when we went 40,000 times 65%. Okay? So we would have been limited at that point. We didn't do that because it was resulted in a loss for us. So we just stopped because there was a net operating loss. All right. So that's what I wanted to talk about for the dividends received deduction. So that way, whether you're taking the exam in class or your enrolled agency exam or your CPA exam, hopefully you have a better understanding of what this business about the dividends received deduction is all about, and you're going to be able to go in there with confidence. So good luck on that. If this video was helpful, please subscribe to my channel.